One more thing that you can take a look at: central bank rates around the world today. So if you look at every single one of these, you can see that there's the rates are extremely low, and that's because the coronavirus has really hit us pretty hard. One place where it's not so low, besides South Africa, if you notice, Brazil, and then Indonesia, they currently have a fairly high interest rate comparatively to the other parts of the world. And did I say Indonesia? Mexico as well has a pretty high interest rate, as well as Russia. So these are current rates that you can see, kind of interesting. So here's a checkpoint. What tools do central banks have to expand monetary policy and to contract monetary policy? So basically, go back through what we just did. If you can answer those questions, good job. Take a pause. So now we're going to move on to monetary policy and aggregate demand. So this relationship that exists, so right, monetary policy impacts indirectly on aggregate demand. This is something I mentioned earlier uh, through the rate of interest, which only affects consumers and investment spending. Um, Basically, if you want to expand, have expansionary or easy monetary policy, it can be referred to as easy monetary policy. What you're going to do is you're going to pursue a policy to grow the demand. So, in other words, we're in a recessionary period where what you're going to want to do is decrease the interest rate and you're going to increase the money supply. So, in other words, I've been talking about this a little bit. Loans are cheaper for consumers and businesses. So this is increasing the aggregate demand. And remember, this is indirect because you make these loans cheaper for people or easier for people to get. Um, it doesn't necessarily mean that people are going to do that. It just so happens that you have the opportunity to do that. If you're trying to tighten up your monetary policy or have a contractionary policy, what you're going to do is the opposite, right? So policy pursued in an inflationary period. So when we have much higher inflation rates, so you know that if we look back a couple of slides, our inflation rate's pretty low. Let's say it went up over 4 or 5%. In order to cool down the economy a bit, what we're going to try to do is decrease the money supply. And so we are going to, as the Federal Reserve, increase the interest rates. Loans are more expensive for consumers and businesses. And so that will basically say that there are not loans. So let's say you're a business that needs to expand production. You might not do it during this time period until you get into a period where there's a little bit more easing of the monetary policy. So inflation targeting, this is a goal, and I mean we will get to this at least nominally before the end of the year, where we talk about the goals of macro, and one of them is to target a certain level of inflation. So monetary policy oftentimes is a tool that is used to inflation target. And what that means is they're aiming for stable and low rates of inflation and low unemployment. And as we just discussed on the last slide, um, you can kind of aim. So if we're in an inflationary period where money is worth less than it should be, or we're growing too quickly, our GDP is too high, and therefore we need to cool it down. They're going to make less money available for loaning. The goal here is to have between 1.5 and 2.5. And like I said, if we go back a couple of slides, you can kind of see there's only been 1 year in the last 10 where we haven't really hit our goal. Same thing with unemployment. Right now, before the coronavirus hit, we were very, very close to full employment of resources. Historically low numbers for unemployment. More often than not, you see with unemployment it's closer to 5% is the more realistic rate, and that's still considered very healthy. So if we look at this, pros are your lower and more stable rate of inflation, improved ability of firms and consumers to predict future rate of inflation. And when you have people being able to predict these things, that has to do with consumer confidence. Greater coordination of monetary and fiscal policy together, and greater central bank transparency. What is bad about this? It reduces resources for other goals. So if you target inflation you're basically saying like, all right, we are looking at this one element, and there are other things that are at play here besides inflation that can affect the growth of an economy. Um, what else this does reduces the ability to respond to unexpected events, right? So if you're inflation targeting and say the coronavirus hits, you might not be in a position to really help, right? So we were in a situation where the Federal Reserve was slowly bringing interest rates back up because we were in a time of growth. Unfortunately, we had this unexpected events, and now they have to drop those interest rates to the floor again. And inflation is no longer something that we're going to be overly concerned about with for the time being. As I said before, you can kind of get a taste for target rate for these different places. They're going to be higher or lower in certain places depending on how everything shakes out. So, checkpoint number 2, step by step, using diagrams, explain how monetary policy can be used to impact aggregate demand in an expansionary or a contractionary period. You need 2 graphs for that. So, give it a rip at your leisure. All right, quickly to evaluate. So this video will be a little bit longer. Understand, there are good and bad, and there are more bad, so I'm going to run through that quickly first. So when we evaluate monetary policy, consumers and investors do not solely rely on loans to make purchases. So, they can have a monetary policy. And so if the only thing that they're really affecting is like the likelihood of people having a loan, then it's not really tremendously effective on the growth of the economy, is it? Might be ineffective in a recession. Rates cannot go below 0, and we're getting into that. We're going to see, right? Because now we have a coronavirus-induced recession, and our rates are pretty close to 0. What does that mean? May conflict with government objectives. So if the government wants to strengthen the U.S. dollar, for example, printing more money or making more money available in the economy is not going to help that goal. Unable to deal with stagflation, which is supply side policy. I'm going to go into more detail with that when we actually hit the supply side lecture. And then monetary policy is never used alone, so there are other things. It's not just one thing. It's not a panacea, so to speak. You need other measures to actually go in time with it. There are time lags. It's shorter than fiscal policy, but it's still not great. With fiscal policy right now, you see that people are still waiting for, say, their stimulus checks from the CARES package. That's taking much longer than it needs to. And now you also have a situation with monetary policy where they cut the interest rates, which makes loans more available. But again, it's not like in real time that people are able to do this or benefit from it. Global markets decrease the impact of one country's central bank. So because we're so intertwined with each other, it's not always going to be effective. The monetary policy not always going to have the intended effect. Pros are relatively quick implementation. There we go. Sorry. Central bank independence. So it's not really politically aimed, and that's a good thing. And they're not constrained by politics either. No crowding out is seen in fiscal policy when you crowd out the private sector by putting money in as the government. Interest rates adjustable incrementally and fine-tuning the economy. So they can change the rates every quarter if they want to, or really anytime they want, and based on what they think the economy is going to do. So take a look real quick at the EQ, last little bit, examine the impact of monetary policy on achieving potential GDP. That is what we have done.